Now it's time for Overlooked Stocks. Today we're taking a look at the drone maker Aerovironment. Had a big rally this week after some strong earnings yesterday. Joining us now is George Tsilis, our senior markets correspondent, to tell us more about this one and why their shares are at an all-time high. So what's going on here? They had a great earnings, right?
Marley, they did. I mean, I think the context of not just the earnings that the company reported recently, you have to consider the environment we're in. Iran is a hotbed. We have Ukraine as sort of a hotbed, and there's a lot of flare-ups, geopolitical, and of course, from a military standpoint. And Aerovironment is essentially an unmanned aircraft systems company. They also have ground vehicles and drones. Drones are about 60% of their total business, and the Department of Defense is not shy on spending money for new technologies, surveillance technologies, missile tactical defense technologies, and that's what AVAV provides the marketplace. And the stock is hitting new highs on a 52-week basis. They did report earnings this week, which were quite good. If you actually look at what they reported in terms of sales and earnings, they reported record revenues 40% higher than the last quarter for the same quarter last year, while at the same time they increased their guidance, both including their backlogged orders, which they demonstrated to be around 726 million, effectively almost an entire year's of sales in terms of backlogs, which last year were 820 million. But essentially the bookings on the forward basis, they've got a lot going for them because they booked about $1.2 billion in the next fiscal year, to which time they actually raised their guidance for the fiscal year in terms of total sales to close to $2 billion. So that's a meaningful number, because if you look at sales last year at 828 million, they're basically expected to more than double their sales. But at the same time, they are profitable as well. There's a lot of drone companies out there that haven't achieved scalability in terms of operating profits, and that's not the case for Aerovironment. The other thing is Raymond James did upgrade the stock to a $225 target from $220, and that is, again, based upon the earnings as well as synergies from a recent acquisition of a competitor called Blue Halo. So they see increased guidance. They also see the positive trends both in margin and sales being accretive on a forward basis. This company's been growing its sales, and that's most important on the top line for movement. But at the same time, it's not a fly-by-night company that's not profitable. They are profitable, generating last year about 43 million in net income on 828 million in sales.
And George, interesting you brought up that Blue Halo acquisition. They are both a drone maker, but also a defense tech company, because they have laser weapons systems. Did they mention much in the earnings call, anything about manning the drones, either with more laser equipment now that they have Blue Halo, or potentially arming the drones?
Well, I think that at the end of the day, they're increasing the efficiency, the higher yield, less manpower in terms of soldier needs and putting soldiers at risk. Their technologies are quite profound. I mean, the other thing is you have to consider, border control, security. These are unmanned drones that are monitoring border projects or border walls and so forth. So that's an important context as well. So I think if you consider, the cost and expense of military in the United States, over $1 trillion estimated next year, the government and the DoD are looking to increase the yield on spending, and that comes from integrating technologies which include arming these devices with high-powered lasers on top of the surveillance. So this is a tactical drone-based business, and it's a technology in the larger context that has a lot more room to run from the standpoint of increasing the efficiencies and higher yield of warfare.
And with their room to run, George, did they mention anything specifically about any intended government contracts or upcoming government contracts?
Not in specific, because I don't necessarily think they let us know who they're selling their products to. But they did indicate that based on their backlog, it actually increased. And subject to that, they increased their total top line sales guidance from around 1.8 billion in the next fiscal year to $2 billion. So it was an additional $200 million in sales guidance. And that's, again, quite meaningful, considering the market capitalization of the firm, which is quite low. So it was quite a big jump in revenue guidance, and that's why you saw the stock jump as a result.
And George, it just looks like we got Nike just in. They were expecting an EPS of 12 cents per share. Looks like they're coming in at 14 cents for their EPS, so a beat on the expectation there. Revenue came in at $11.1 billion. That was expected to come in at $10.69 billion. So better than expected on the top and the bottom, a beat for Nike. But you know, all in all, it was going to be a struggle. We all knew it was going to be a struggle for this company. They even knew it was going to be a struggle. You know, what are your takeaways here? They got their beats, so it's not going to be quite the bloodbath that maybe some people were expecting.
Correct. I mean, at least so far, we'll have to see how the market reacts as the news is digested here. I mean, first off, guidance needs to be revised, and that's important because guidance for sales between this year and next year are expected to be down once again by about 6%. So that's the first thing. Despite the beat on both top and bottom line for the quarter, the stock is drifting slightly to the downside. I think at the end of the day, you know, the estimates keep moving to the downside for Nike, and therefore the price keeps moving to the downside. One of the things I notice about the business is they've been able to maintain quite supportive profitability at around 9.5% of sales. The balance sheet is quite strong with cash on the books around $10 billion on about $90 billion in market cap. The challenge really is growth, and the growth really challenges have come from a few factors, which include the DTC channel that they made an explosive move into. They crowded out other resellers, Foot Locker, Amazon, which they're actually going back to, by the way, which they discontinued back in 2019. They lost a lot of digital ad revenue. And that's on top of lost innovation and competitiveness to competitors like Hoka, which is the Deckers brand, On Holdings. And then the other factor is more exogenous and macrocentric with China. And even China sales for the quarter, if you note, down 21%, North American revenue down 11%. And they did make, as a company, an aggressive push into China. So direct-to-consumer channel push into China has not necessarily manifested into accretive earnings and sales for Nike. In fact, if you look at the last 3 years, it's like a melting ice cube. It's been down from its highs around 128 going back to early 2023.
Well, George, it looks like the street is pleased. They were down more than 2.5% when we started talking. Pretty flat right now, about 62.50. So thank you for that. And thank you for Aerovironment as well.